Let's look at the scoreboard. If this investor just bought and held, she'd have $224,000. But because she tried to time the market, she's down to $102,000.
That is unfair. She was dodging a crash. The market is a super bubble.
She didn't dodge a crash. She dodged her own retirement.
Welcome to the debate. Okay, today we are basically performing an autopsy. We're not looking at a person. We're looking at a crime scene of capital allocation. We are analyzing the portfolio behavior of a retail investor. Let's just call her the case study based on, the real records of Demi Wong. And the question here is, it's brutal, but it's necessary. Is the fear of a market crash a survival instinct, or is it just a tax on the ignorant? I'm arguing for risk management, for macro awareness, and for the belief that, trees do not grow to the sky.
And I am here for the cold math. I represent the quantitative side, lump sum investing, market efficiency, and the absolute elimination of human emotion. Because as we're about to see, feelings are the most expensive luxury item on Wall Street.
So let's set the parameters. We have a retail investor, relatively young, in her accumulation phase. She starts investing in, late 2022? The vehicle is a VOO, the Vanguard S&P 500 ETF. All very standard stuff. But when we look at the data, the actual transcript, we see a pattern that just screams retail panic. She sees a rally, she freezes. She sees a dip, maybe she buys a little. She's trying to dance with a market that moves faster than she can think.
Oh, she's not dancing. She's tripping over her own feet. Just look at the behavior log. November, December, the market's beaten down. Sentiment it's just terrible. So what does she do? She's confident. Throws in $300, then $350. She feels good because she thinks she's buying a deal. But then Q1 rolls around. The market starts to sniff out a recovery. Prices tick up, and what does our case study do?
She pulls back.
She chokes. She completely chokes. In January and February, as the green candles start printing, she cuts her contribution down to $140. Then comes June. The rally is undeniable now. Tech is ripping, and she invests her lowest amount of the entire period. She even says it in the transcript. It's very emotionally driven. She saw the price go up, felt like she missed the boat, and then she just decided to wait for the boat to come back.
You call it choking. I call it valuation sensitivity. She's looking at a chart that has gone parabolic, and she's saying, I am not going to chase this. That's not panic. That is a form of discipline. She's trying to be a value investor in what is obviously a momentum market.
No, she is trying to outsmart an algorithm. By manually toggling her contributions based on the vibe of the market, she effectively shorted her own potential. She missed the bulk of a 20% plus rally in 2023. So my thesis is simple. In the data, prudence is completely indistinguishable from loss. She committed the cardinal sin. She let the price action dictate her conviction.
I see why you interpret it that way. But you are judging her process by the outcome of a single, frankly, irrational year. You're spiking the football because the drunk driver somehow made it home safely. My position is that the case study is observing a macro environment that is flashing code red. We are not in a normal business cycle.
Uh-oh. Here comes the doom.
It's not doom. It's just arithmetic. We are sitting at a Shiller PE ratio of 40.63 as of, January 2026? Do you understand what that means for people listening?
It means stocks are expensive. It means they are priced for utter perfection in a world that is fundamentally breaking. Let me use an analogy. This Shiller PE is like the price-to-rent ratio on a house. Historically, the average is roughly 17, okay? That means you pay $17 up front for every $1 of rent the house generates. Right now, you are paying over $40. You are paying a mansion price for a shack's cash flow. The only other time in history we paid this much was 1999, right before the dot-com crash erased 50% of the market. When the case study pulled back in June, she wasn't choking. She was refusing to pay $40 for a $17 asset. That is alpha.
Poison. You are talking about valuation compression, which takes years to play out. She needs to compound capital now. So let's move to the core debate, because I want to hit you with the Vanguard data right away. We are effectively debating lump sum investing versus dollar cost averaging. She was holding back cash waiting.
She was keeping powder dry for a better entry point.
She was betting against the house. Vanguard released this comprehensive paper, Dollar Cost Averaging Just Means Taking Risk Later. They ran the numbers, US, UK, Australia. They compared investing a lump sum immediately versus spreading it out over time. And the results are, they're not ambiguous. Lump sum beats dollar cost averaging approximately 66% of the time.
Which means it fails 33% of the time.
2/3 of the time. Putting the money in immediately wins. Why? Because the market has a positive expected value. It trends up. Cash drag, the opportunity cost of holding money in a savings account, is a mathematical certainty. A crash is only a possibility. By waiting, the investor was betting she could perfectly time that 33% window. and she was wrong.
Okay, stop right there. You're glossing over the 33% like it's some rounding error. I mean, in probability theory, sure, 66% sounds great. But in wealth management, the tail risk, that 33% is where you die.
You don't die, you just underperform slightly.
No, you get wiped out. If the case study had lump summed everything in September 1929 or March 2000 or late 2021, the absolute peaks of what Jeremy Grantham calls super bubbles, it would have taken her over a decade just to break even. Vanguard explicitly admits in that same paper that DCA minimizes regret. You dismiss regret, but regret is what causes capitulation. If she lump sums at the top and the market drops 50%, she sells at the bottom. The 33% failure rate of lump sum investing isn't just underperformance, it is wealth destruction. You are asking her to play Russian roulette because 5 out of 6 chambers are empty.
I am asking her to play the probabilities which favor the bold. If you spend your whole life terrified of the one bullet, you starve to death. But you keep mentioning super bubbles. You are channeling the bear case from GMO.
I am. And this is where your cold math completely fails to account for the hot reality of the physical world. We are in the final act of a super bubble, a 2.5 sigma event.
Sigma event. Explain that. Don't hide behind the Greek letters.
A sigma represents standard deviation. In the normal distribution, a 2.5 sigma event is a statistical anomaly that should happen, maybe once every 80 years or so? It's a 100-year flood. We are standing on the dam, looking at the water rising, and you are telling her to swim because, on average, the river is calm.
And what is causing this supposed flood?
It is a convergence of 3 impossible things.
I'm sorry, I don't buy that. You are weaving a narrative of doom that has been about to happen for a decade. The end is nigh is a great slogan for selling newsletters, but it's a terrible strategy for building wealth. While you were worrying about Moroccan phosphate, the S&P 500 hit all-time highs. But let's say you're right, okay? Let's just say the danger is real. I want to introduce the kill shot from the Hartford Funds data. This is the argument that just destroys the logic of market timing even in a bubble.
You're talking about the best day study.
It is the single most critical piece of data for any retail investor. Hartford Funds analyzed 30 years of market data from 1995 to 2024, and they found a totally counterintuitive truth. 78% of the market's best days happen during a bear market or during the first 2 months of a bull market.
Which implies extreme volatility. That proves my point. It's dangerous.
No, it implies that the recovery is explosive, it's sudden, and it's terrifying. When the market rips, it rips when things look the darkest. Let's look at the calculation, the one that highlights the case study's $120,000 mistake. In their scenario, a fully invested portfolio grows to $224,278.
That is scenario A, the ignorant bliss portfolio.
Correct. Now consider scenario B. The investor gets scared, like our case study did in June, and she tries to dodge the crash. In doing so, she misses just the 10 best days of the market over that 30-year period. Just 10 days, less than 2 weeks of trading action. Her return drops to $102,750.
Wait a second. That cuts the return in half?
It is not a haircut, it is a decapitation. By trying to dodge the bear, she missed the recovery. That cuts our returns by 54%, and if she misses the best 30 days, she is left with $38,114. That is 83% less money. The logic of risk management that you are defending is actually the riskiest strategy of all. You are terrified of a 40% crash, so you voluntarily take a 54% loss by missing the upside.
I have to push back on this. You're using data from 1995 to 2024. That entire period was defined by falling interest rates and the Fed put. The central bank always came in and saved the market. If we're in a regime change, if inflation is sticky because of the resource constraints I mentioned, those best days might not come. You are looking in the rearview mirror to drive forward.
And you are looking at a crystal ball. The regime change argument is pure speculation. The data is empirical. Even in the 1970s, the worst stagflationary period in modern history, if you missed the best days, you got crushed. The math holds. The only way your strategy works is if you can time the exit perfectly and time the reentry perfectly.
Which is impossible. I can see that.
Exactly. You have to be right twice. And the data shows that the best days happen when the headlines are the worst. When Grantham is screaming tragedy and super bubble, that is usually the exact moment the market rips 5% in a single session. Short covering kicks in. Relief rallies happen. If you're sitting in cash because you read a scary article, you miss it. And once you miss it, you never, ever catch up.
That is a very sobering realization. The cost of safety is higher than the cost of the crash. But let's look at what she did do right, because even if her timing was off, her execution was surgical.
Well, here we go. The penny's defense. Wealth. Time and market is idling.
I'm not convinced.
You're treating psychology like a bug in the code. I'm treating it as a feature of the hardware. If optimizing those fees gives her the feeling of control she needs to sleep at night, it has value. If she's fully invested and the market drops 50%, she might panic sell everything. By optimizing her process and keeping some cash on hand, she stays in the game.
But she didn't stay in the game. She explicitly said it. I did not dollar cost average my way consistently. It's very emotionally driven. She knows she failed. She isn't claiming this was some masterstroke of hedging. She admits it was a mistake. She realized her own brain was her worst enemy.
And that brings us to the solution, the consensus. Because despite our disagreement on the macro versus the math, we both agree on the mechanism she needs to deploy in 2024 to fix this.
Automation. The robot. She says it herself. The mistake is what I plan to correct in 2024. She plans to set up recurring buys, $400 USD monthly, no thinking aloud.
I agree with this, but I suspect for a totally different reason than you do. You want her to automate so she captures the upside and doesn't miss the best 10 days. You want her to be a mindless participation machine.
Correct. I want to remove her prefrontal cortex from the equation so compound interest can do the heavy lifting. I want her to be a dumb buyer of smart assets.
And I want her to automate because it acts as a psychological seatbelt. I still believe the crash is coming. I believe the Shiller PE at 40 is a siren song. But I know that when the crash happens, she won't buy. She will freeze. When the news is talking about war and phosphate shortages, every fiber of her being will scream sell. Automation forces her to buy. It forces her to ignore the super bubble and acquire assets when they are actually cheap.
So we arrive at the same destination from opposite sides of the cliff. You automate to survive the fear, I automate to exploit the math.
Precisely. We are walking off a cliff. I truly believe that, given the resource squeeze and valuation metrics. But you cannot afford to sit on the sidelines because inflation will just eat your cash. You must invest, but you have to do it with your eyes open to the tragedy Grantham predicts. Automation forces you to buy low when that tragedy eventually hits.
And I say, the data is binary. You are either in the market for the best 10 days or you are poor. The super bubble theory is just a scary story to sell gold. The $120,000 loss for missing those days is hard, verifiable math. The only way to win is to surrender to the algorithm.
Whether you're guided by fear or greed, the answer remains the same. Stop touching the buttons. There is always more to explore in the data. Thank you for joining the debate.